So again, obviously, you guys know we're going to go through some of the products that we offer, some of the niches. We're an Alt-A lender, so I'm just going to jump right into it because we're a little bit behind. So we're a flexible alternative to the larger, more traditional institutions. If you have, basically, to summarize, if you have a more complicated or unique deal, reach out to us, reach out to me directly, and then we can go through the deal together and see if it's something that I believe we would consider. This is just a couple of the basics to note. So minimum FICO score of 500. That's if you want LTV greater than 65%. GDS, TDS guidelines are 50-50. We do have programs that offer higher GDS, TDS. I can send out a mass email after the presentation, just kind of breaking down the criteria. But we definitely have programs that offer GDS, TDS in excess of 60/60. So keep that in mind. Amortization, we offer up to 35 years. Our terms, we have the 1, 2, 3, and 5-year term options. And then we have the 2, 3, 5 with fee and no fee options. Max 65% on non-conforming. Any non-conforming deal would go back to GDS that is in excess of 60/60, GDS, TDS. So if the ratios are in excess, we cut back to 65 automatically. Expensive lending areas, we'll get into that a little bit later. We will not lend on insured mortgages. We will not lend on holdcos or student housing. If anyone has any questions, the group isn't too big, so you can speak up or save it for the end or send me an email afterwards. It's really up to you guys. What Community Trust brings to the table. So we have a new construction program. We have a rental program and short-term rental programs. So we'd accept income from Airbnb. Again, these are just points. I'm going to get into it in the next few slides. We offer HELOC and secondary financing. We're going to discuss a couple of our niche products that are, unique in comparison to other lenders. And then we're going to get into our shared equity program. Okay. So, excuse me. So our new construction, this is one that our brokers actually really love. I don't know how familiar you guys are with this, but basically to summarize this slide, we'll take the current market value of the property if the purchase agreement was signed 1+ years ago. So this is new construction, new build. This is not a custom home, obviously, right? The loan amount may not exceed the original purchase price. We'll accept assignments. And this program applies to both owner-occupied and rental subject properties. So again, if the value comes in higher in today's date, as opposed to, let's say they signed the agreement 2-3 years ago, we will take today's date and your clients can essentially get some of their, let's say, deposit back, right? That's that. And then just something to note for the new construction properties. If the appraisal report states as is and as if completed values, we will take completion of 80%. There's just a couple points that need to be hit in order to accept the 80% completion. So obviously the appraisal report. We'll need confirmation of the provincial warranty. And then we'll need occupancy certificate issued by the municipality. Okay, so I know that sometimes with these new constructions, there may be slight delays because of the completion, so just keep this in mind. InstaValue, so this is a product, not a product, it's a service that we offer to your clients actually. So it's a cheaper alternative to the more pricier appraisal reports. So basically, once we get the deal, we identify whether it would qualify for InstaValue, and we run an internal report on the value of the property. So it's quick and easy. You know, you don't need to arrange for the appraiser to go into the property. Values very accurate. You know, sometimes we get a little bit of pushback where brokers will do the InstaValue and then they get an appraisal company to go in, and the value is pretty much the same. So keep that in mind. To qualify for the InstaValue, the deal must hit these program details. So obviously, so purchase and refi, that's pretty straightforward. The property must be an owner occupied. We'll do LTVs up to 80%, and minimum FICO of 610 plus, and maximum property value submitted 1.5 million. Okay. So one thing that I would mention is our underwriters are technically supposed to catch every single deal that comes through the door that qualifies for InstaValue. Sometimes they may miss it. So if you do have a deal that hits these specific criteria, mention it in the submission notes. Okay. That's that. Now our rental income program. So we will accept rental income on both subject and non-subject properties. We'll do up to 80% LTV, max 6 properties, no max doors. So for subject rental and owner occupied, we'll do 90% rental add back. You have to include 50% condo fees if applicable, and 100% PITs. For non-subject rental, it's a 90% offset, okay? And just make note, we have a rental worksheet, but it has to stay internal right now. If you'd like to, because I don't know what platform you guys use, if it's Filogix or whatever it may be. Sometimes when you're putting in rental income and you submit the deal, the lender may get a little bit of a different number. If you want a more accurate figure, you can contact me directly. We can work through the numbers together on the worksheet, okay? Rental income is verified through lease agreements. In some cases, we may require fair market rents or bank statements. That's just if we believe that the rental income submitted is a little bit unrealistic. But in most cases, just the lease agreement will be sufficient. One thing to note is if you're submitting a purchase of an investment, if the client doesn't have an owner-occupied, existing owner-occupied, we'll have to include $1,500 shelter cost. It's a little bit steep, but that's the number right now. Hopefully they drop that a little bit. Our short-term rentals. So we will accept income from Airbnbs and Vrbo. So for subject property, we'll lend up to 75% LTV. We'll require fair market rents to validate the rental income. We'll require home insurance and the home insurer to confirm and acknowledge that they're aware that the property is being rented out short-term. And this product is an additional 25 bips. If it's a non-subject short-term rental, we'll need either 12-month bank statements or just 12-month payment history. And then we'll just need a snapshot of the profile, like whether it's Airbnb or Vrbo, just showing that the property itself is still being listed for short-term rental. Now our HELOC and secondary financing. So our HELOC, pretty straightforward. It's an open. Minimum loan amount $100,000. In first position, we'll go up to 65%. The rate is prime plus 3, and then there's a 1% fee split. In second position, 80% combined LTV. So the HELOC portion may not exceed 65. So just keep that in mind. And rate-wise, you're looking at prime plus 4, and then there's a 2% fee split. I know I mentioned earlier in regards to GDS, TDS that we're flexible, which we are, but with the HELOC, we're stuck on the 50-50, no exceptions. So just keep that in mind as well. Max amortization 30 years on the HELOC. Okay. Every other product will go up to 35. Second mortgage, so as I stated already, so the second mortgage is a fixed mortgage, whereas the HELOC is an open, it could be paid out at any time. Okay. So the second mortgage is a fixed minimum loan amount of 100,000. If they are existing with us, we can potentially approve them for 25 minimum if they just require a couple, a smaller amount. Confirmation whether the first mortgage charges standards will go up to a combined LTV of 80%. And if it's a collateral, 65. Minimum FICO for the primary applicant only is 580. Okay. And this is just, I'm not going to go through every lender, but this is just a quick glimpse of the lenders that will consider going behind in second position. Okay. So pretty much all of your A lenders. And then you have at the very bottom there, the credit unions will go behind as long as they're regulated. Pretty much the only lenders we won't go behind are B lenders and privates. It's just a little bit too risky for us. So now just a couple of our niche products. So our rates, so when we're doing our pricing, it's actually priced based off of the client with the highest credit score. So regardless of them being primary applicant or not, as long as they have income, we will price it based off of their score. Cosign, that's excluded. So basically, let's say a parent signed a cosign for their child's vehicle, for example. If we can show that the child is paying the vehicle monthly, we can exclude it from the ratios, the parents' ratios. So totally wipe it out of the liabilities. And how we would confirm that is through bank statements, the child's bank statements. So I believe it's 1 or 2 months that we would require, and then we're good to go. Shared accommodation will take up to $1,000 a month. If the client has, a friend, let's say, living with them, to confirm this, we'll need a lease agreement and 3-month bank statements. So this is a good one to kind of keep in your back pocket. Let's say you have a deal that's not really rushed to close, a refi, for example. You can kind of position the deal in a way where, let's say, they do have someone living there, but they don't have, let's say, a lease agreement, and you can close in 3 months. You can kind of get that going, and we'll totally accept the shared accommodation income. We do have contributory income, but that's only on our non-conforming deals. So that's where the ratios are over 60-60. Again, I will send you guys details on the non-conforming and all of that stuff. It's just, there's a lot of info. So to have it in email is more beneficial, in my opinion. We'll consider bankruptcy, double bankruptcy, proposals. Even if the proposal is still existing, we'll consider the deal. We just need to show proof that the client has been paying as they arranged initially. Okay. Now, just some of our income sources that we accept. So pretty standard: salaried income, commission, we'll accept contract. Other income that we would accept, so child tax, you have your child support, pension income, disability. We'll accept 100% of all of this income. So keep that in mind. Salaried income, just job letter, pay stub, commission, 2-year T4s. I think that's pretty typical with most lenders. Now we're going to get into the business for self. So I would say that probably 90% of our deals are BFS deals. So there's two ways to go about the BFS program. So you can obviously take the financial route, or financials, so you're like T1s, things like that. Or you can do the bank statement route. Obviously, a lot of people who are BFS, business for self, are not claiming all of the income that they're making. So many of our deals are with the bank statement route, right? So to submit the deal and get it done under bank statement, all we would need is proof of BFS. So either articles of incorporation, business license, just something to show that the business is active. We would take 6-month bank statements, annualize it for the full year. And then we would just need a couple invoices to match some of the deposits. We would need just a couple expenses. So we do have a business disclosure statement that we would request. And basically, you would list 2 fixed expenses and 2 variable expenses. And that would be it. So our bank statement program, I would say, is a very popular one. Just one quick thing to note is if you're using over 100,000 to qualify the deal, we will need to show the deposits going into a business bank account. Anything less than 100,000 can be going into personal. Okay. And sorry, just one more thing to note, because as I mentioned, we're going to have to show proof of business for self. So let's say the articles show ownership is like split 50-50, then we would take 50% of the deposits, or we would split it however it shows in the articles. So keep that in mind. Now our lending areas. We have a approved lending list. So I don't know how many of you have our broker kit. In the broker kit, we have a whole list of cities and towns that we lend in. Just keep in mind, brings me to the next box there, the proximity rule. So if, let's say you have a unique property that's outside of the GTA, and I'm talking like outside of the GTA, and it's not on our list, give me a call. We can work through the property together. Basically, if it's within close proximity to one of our lending areas, we may consider the property. What I do is if I get a deal and the property is, I don't know, like past Sudbury, for example, I just take the address and I send it to our property valuations team, and they give me an accurate representation of whether or not they would consider the property or not. So it's our appraisals team. Insta value, we've already gone through that. And then we have an appraisal list. And in addition to the appraisal list, we have actually joined with Solidify. So you could order appraisals through them as well. And RPS, actually. Now our shared equity. So I believe it was last year, probably around September, where we joined with Arbor and Lotley. So it's mortgages with shared equity. Basically, to summarize this slide, if your client has, let's say, 5%, which is the minimum requirement for this program, so 5%, Arbor will come in and they will put down another 15% to hit the 20%. They are not on title as a co-owner. The clients can pay the property or sell the property at any moment. The SEP does not require any repayment unless mortgage is paid out. The SEP may not charge any fees. There's no scheduled amortized payments owing to the SEP, and the SEP is not responsible to make any mortgage payments. So obviously it would fall on the client. They're just there to contribute to the down payment. And the way and the benefit for them, a lot of people are kind of like, how do they benefit from it if it sounds really good, right? Basically, if however much the property increases in value is what they get back, right? So whatever their share is, they get back and then some based off of the property value when they sell or refi or anything like that. Ineligible products for the SEP, non-conforming HELOC and seconds, eligible occupancy, so owner occupied, and then owner occupied with a rental component. So let's say a rental basement. And then transaction purchase, obviously purchase only, unless your clients enter this through Arboro and then they're refinancing in a couple years, then they can pay them out. But that is that. So just a quick recap of what we've discussed. We have our special programs, so the current value for new construction program. We have our high credit and non-conforming, which, as I said, I will send out a mass email afterwards, outlining all of those. We'll take 80% completion if the report states as if and as is value. We have our insta value for owner occupied. And just as I mentioned, make note in the submission notes just to kind of trigger the underwriter. They should catch on to it, but just gonna put that out there. We accept rental income as well as short-term rental income. We have our HELOCs and our fixed seconds. We have our BFS stated income program, so the 6-month annualized for the year. We have our extensive lending areas. So just to note, it's actually not in our slides, but we obviously lend in Ontario, but we've expanded to BC, Alberta, and Atlantic Canada. We've collaborated with Arboro, which is the previous slide that we just discussed. Chat received. Okay. And then Community Trust Cafe portal. I'm not too sure how many of you are familiar with this, but basically once you've submitted your first deal, we'll get you set up, and all business is done directly through the portal. So you're going to communicate with underwriting, upload documents, and get status updates all through the portal. And then, of course, if you have any issues or questions or anything like that, you would come to me directly. Let me see the chat. That's correct. So whatever they contribute initially is what they get back at the end. I hope that answers the question. So that's my extension, my telephone, my email. Like I said, I'm going to get a list of everyone that's attended today, and then I'll send you all a quick email just recapping everything. And then for future, if anyone has any questions, you can reach out to me directly, and then we will go from there. Does anyone have any questions? Good. That's good.
Questions, team? I think it's very clear, concise, that they don't have any questions as of the moment.
That's easy for me, never mind. So I'm not complaining.
Yeah. Team, this is your opportunity to ask questions to Daniela for the program and product and niche of Community Trust. Okay.
So sorry, Rosie, is that you? Is that you're the one who arranged the?
No, this is Sarah.
Okay.
Yeah,
okay.
This is Sarah. Rosie is having some technical difficulties. That's why I am the one who started the webinar. So this is Sarah from the underwriting team.
No problem. Okay. Sounds good. Like I said, I'll reach out to everyone that attended today individually just to kind of recap, give my contact info. And then, you know, if anyone has any questions, we can connect offline, right? And then go from there.
Yep, definitely. If you don't have any questions now. I just wanted to say a big thank you to Daniela for that fantastic presentation. It is incredibly helpful, and it'll definitely help us and our agents in structuring and submitting deals to community trust. I don't think we have anything. Thank you so much for taking your time and sharing your expertise. And thanks everyone as well for joining us today.
Thank you so much, Sarah, for joining, and thank you everyone else for joining as well, and we'll connect soon.
Sorry, I think we have questions.
Oh, okay.
What are the maximum ratios the community trust can go? I think they are flexible.
Yes, so we will do 50. Oh, is this the box there? Oh, GDS, TDS. So maximum that we'll do is, not maximum actually. So we have a program like policy wise, it's 50-50. And then anything above 50 to 60 or below, it's our high credit program. And then anything above 60 is the non-conforming. So that's when we cut back the LTV to 65% max, but we'll still consider the deal potentially. So it's kind of broken down. So like up to 50, you shouldn't have an issue. 50 to 60 is our high credit. I'll send you guys details on that. And then 60 above, it can go, I've had deals that go up to 90, but it has to fit a certain criteria or non-conforming, and there is a cutback to the LTV. I hope that answers that question. Are there any more there? No, we're good. Okay.
We're good. Yeah, thank you so much. Thank you again, Daniela. You have a great afternoon.
Thank you, Sarah. Take care.
Okay, bye everyone.
Bye everyone.
Bye.